Good morning, ladies and gentlemen. Today is August the 3rd, and we've just had a very active and volatile week, haven't we, Andy? What do we have first? We had the QRA, and I'll let you talk about the QRA, I think. You're the expert.
Yeah, sure. So, as we expected, they maintained coupon auction size. They increased the buyback. That was all telegraphed to us. And what we were unsure of was whether and they changed the TGA modestly to reflect the lower expiration of bills at the end of the year. All again in line with expectations. The only question was, were they going to target a higher coupon issuance in the coming quarters, change the language? And they didn't. So we expect ongoing supply of about 500 billion of net coupons for the foreseeable future. That number will likely have to grow, but this quarter it didn't, so it was mostly in line with expectations. So then the next question was, what was going to happen in the FOMC? What do you think about that, Nick?
Yeah. Well, the FOMC was actually, the statement was slightly more hawkish than expectations, even though we fully expected them to do nothing, because none of the data up to that point indicated that there was any real reason to do anything as yet. But, Mr. Powell is a very dovish chairman, and whenever he appears, he can't help himself but be dovish. So the market actually took off as soon as he started speaking and never looked back in terms of the bond prices, simply because he confirmed that they are in effect looking to cut in September. They're just looking for even more reinforcement of that view from data over the course of the next couple of months. So that was the FOMC, really as expected, nothing to write home about. And we told you that really we were doing nothing on the back of it because we were very happy with our positions concentrated in the short end of the bond market, which is the one that reacted most. And then, throughout the week, we had the big tech earnings, and those were fine, right? I think we can describe them as fine, small beats. Apart from Meta, there was a larger beat. And, but those were like, it felt like they were fully discounted by the market. The market was not surprised by them. And they were really met by selling. Every time those stocks started to go up, they were sold and they came back down. So again, nothing that we haven't told you about before. And we seem to be about right where we are with our predictions. Now, what was a surprise last week was the PMIs on Thursday, and really especially the NFP on Friday. The PMIs on Thursday showed a slight weakness on the employment side, and that was really confirmed and compounded by the NFP on Friday, which showed very weak private sector growth in employment and actually weaker than expected average earnings, which would suggest that there is no reason to expect inflation to accelerate. In fact, there's every reason to expect inflation to moderate over time. Whether it's going to moderate more than expectations is neither here nor there, but it just removes inflation currently from the equation, from the way the market thinks about yields. And it shifts the probabilities to lower growth, right, from weak employment growth, especially in the private sector. And remember, the private sector is the one that's going to drive things. So the market really, really started getting very cautious about growth. And therefore, we started having quite a big sell-off in equities and a ramp up in bond prices, especially at the short end. And now we're about 65% likelihood of a 50 basis point cut in September. And also on Friday, we had banks like JPM and Bank of America coming out with expectations for 250 basis point cuts this year, starting in September. So yield curve kept on disinverting, i.e., steepening. And that's where we are now, with people still degrossing and still afraid that we are going into a period of much slower growth. Would that be a fair reflection of what you think is going on, Andy?
Yeah, I mean, there's a huge change in sentiment reflected in the short end, going from the SEP, which was in June. We look at the data, and the data has softened, and so I would expect the Fed to want to cut more, consistent with their moderation or normalization cuts that they've been talking about since almost a year now. And they had planned a normalization cut of one cut in 2024. That SCP has been, what's happened since has largely been reflected in their predictions. But without a doubt, they're going to make in September a cut, and they're going to project further cuts. The question becomes, has the macro environment changed in a meaningful way to suggest the Fed is not too late, but late to the game in terms of cutting, and whether the Fed will be willing to not only remove the extra hikes that they did, which was to restrict and normalize, but to begin accommodating for a weak economy. And I was on CNBC last night. You can look at that on the web. Basically, I mean, on my Twitter feed. Basically, I think we're now at a point where the market has begun expecting the Fed to make accommodation cuts, and an accommodation cut is only occurs when the probability of a recession or an actual recession is occurring. So you don't get accommodation cuts until something breaks in the economy, whether a financial institution, like over the years have happened, or the economy rapidly falls. And so the market is expecting accommodation cuts. And the question is, will those come through? And 50 basis points, which Nick rightly said is the prediction by many analysts now, and the odds in the market pricing is for 67%. That's more likely 50 than 25. So we're in this interesting period where, and I think it has a lot to do with the flows of degrossing more so than investors all of a sudden deciding that the macro view has changed in some meaningful way such that an imminent recession is coming. It's really about the degrossing that Nick talked about. When somebody sells something because it's been going down and they need to get their risk down, they sell a risky asset. Now they have cash. They have to put it somewhere, and they put it in something very safe. And that very safe thing is 2-year notes. And for them to buy 2-year notes, they don't mind paying up 5 basis points in price, which is 10 basis points in yield. And so the rapid fall in price in assets has caused a rapid demand for 2-year notes, and then people are following that and assuming that degrossing is predictive of what the Fed will do. And I think it's important in that context to say what our macro view is. And our macro view has been fairly consistent for a while now. We haven't been panicking about a recession. We haven't been panicking about inflation reaccelerating. Our view had been before this episode that the economy was fine, was good, and inflation was coming down, but likely to be sticky on the way. I'd rephrase that today and say the economy isn't quite as good, and inflation may be less sticky and is coming down, which, by the way, isn't an imminent recession or a massive sell-off in massive job loss phase. Now, it could become that way. Markets expect it, but that's not our view.
Yeah, no, I think markets are overreacting, and I think the overreaction can continue, but that is neither here nor there. The situation, what has changed for sure, is that growth this quarter and probably next quarter is going to be less than we anticipated. It's not going to be in the threes. It might not be in the twos. So that has changed, and therefore, probably what needs to change is the expectation of or rather the valuation expectation of earnings growth, which at the moment is in double figures for the equities. People are still expecting double figure growth in earnings, and that is becoming unrealistic with an economy which is not growing as fast as predicted or expected. And therefore, equity prices are really vulnerable at the moment. When there is vulnerability in equity pricing, that increases the volatility of the equity prices. People buy protection, people buy puts, or they sell outright and they speculate with puts or short calls or whatever. But what that does is increases the volatility, the VIX level goes up, degrossing takes place. And that is likely to continue for quite some time. I don't think we've seen the bottom of it. And that is why I think that our portfolio is probably in the right place, isn't it, Andy? I just wouldn't know what to do to change it very much.
Yeah, I mean, given our central outlook, equities just don't have much value from a standpoint of meeting earnings expectations and maintaining multiple in a degrossing. So, you can't be super bullish on equities. And yet our exposure is we own calls in case we're wrong, because we're not, we could be wrong. And the economy could reheat for that matter. And we own calls for September that are struck a little bit above the money now. And if they go in the money, we have a meaningful equity exposure and we catch that exposure. But really with very little downside. And so for us, it's about if we don't, worst case, these calls expire worthless, and that's no big deal to us. If we don't, we'll be underinvested in equities. And so what happens in a downside, Nick? What do you think if we're right and the economy isn't going into a recession, but expectations for equities are just too high? When do we start buying and how?
Well, we have been down 3 weeks on the trot, and we are what 6-7% off the highs in the spies and double figures now in the QQQs, which will always underperform during some kind of a bear phase or correction. So I don't know. We need to pick some kind of a technical level where the market is likely to stop. And I always prefer in these phases, and I've done it many time over the years, is what I like to do is pick a technical level and then sell very short dated puts, and then keep on rolling, because people always expect that any market correction is going to take, I don't know, a week. It's not. It's going to take months. And therefore selling and keeping on rolling the puts, if they don't get exercised, I find it's much more profitable than just selling 3-month puts and walking away. So that's my experience, and that's what I will talk about in my segment later.
Fantastic. So, again, on this televised appearance on CNBC, I talked about being short what we're long.
Yes. But
Twos.
shall we explain why we would not uh, recommend that this kind of portfolio does that kind of trade? I think
100%.
people
I
have,
think it's key that that my short twos and short spoos is a hedge fund trade designed to be something other than anything I'm considering in my beta portfolio. Beta portfolio owns unlevered cash instruments. We should talk about that.
yes. So this is the way I look at it. If you think that the economy is weakening or the probabilities of the weakening are rising, why would you own anything but short-term bonds to hedge yourself from falling risk prices? You wouldn't. So let's say that you are wrong. Let's say now 4-year notes, let's say they're 2-year notes rather, let's call them 4%. And let's say they go to 4.20% because you were wrong. How much have you lost by owning Shy or the other instruments that we have? Probably very, very little indeed, if you take into account the dividends they pay. So the hedge fund trade, the short twos and short spoos, could be very right. And what we would lose is negligible, absolutely negligible. It literally in the hundreds of dollars. What would we do with the money? Say that we went out and sold our whole bond portfolio tomorrow, all the Shy, all the IEI, everything that we own, the tips, the stips, everything. Where would we put it? What would we do with it? Well, the only trade that we could reasonably do is buy USFR and earn 540 for that period of time. How much are we going to make by doing that? It's going to be negligible. It can be measured literally in the hundreds of dollars. And what do we have then? We have a reinvestment risk. So, what if we are wrong? We just assume a huge reinvestment risk from that USFR that we hold. And now we have to go and rush and buy back the Shy, the IEI, and everything that we sold at much lower prices. And that's going to cost us much more. So for an unlevered portfolio like ours, which is trying to outperform basically the cash yield over time with reasonable risk, this trade makes absolutely no sense.
Completely agree. I think I will continue to hold short-term bonds in my portfolio. I have cash exposed, unlevered positions exposed to short-term bonds, short-term cash paper, just like the Two Graybeards portfolio. There is no sense to trade out of a unlevered cash portfolio because you have to reinvest it. You don't want to buy equities, you don't want to buy gold, you don't want to buy commodities, you want to buy something safe. That's the whole point. And money market funds and 2-year notes are essentially the same thing. Now, let me, on my hedge fund trade, try to squeak out a little bit of the levered exposure in that might pay me a small amount and hedge potentially my equity exposure. That's not the game we're playing here. I completely endorse what we're doing, despite, which is keeping cash safe, underexposed in equities.
And that's where we are. The only thing that we haven't talked about is what's going to happen next week. And very little data, right, Andy? What we got ISMs on Monday, ISM PMIs on Monday, and then a whole load of auctions, 3s, 10s, and 30s, which are bound to go very well because the market is bullsed up and it needs paper and they will buy them. I mean, there's not a lot to think about there.
Yeah, my guess is that you're going to also see, because earnings have just ended, you're going to also see massive corporate issuance on top of the Treasury issuance. I would be shocked if Apple doesn't do a benchmark issuance in the tens of billions of dollars. So there's going to be supply. But again, there's certainly demand.
Yeah. And then we have weekly claims, which is the other thing that the market will now shift to looking at, having had that weak NFP. Do weekly claims start accelerating? And what if they do, Andy? Then again, it's people buying the hell out of the short end and selling more equities.
Yep. That's what's
all
going
that
to
can be said.
that's what's going to be happening. I don't, again, our play here is if equities rally for whatever reason, we're protected, but we're underinvested in equities because the situation isn't good at the moment.
And that's all we have for you today. Thank you very much indeed. Bye-bye.
Bye-bye, guys.
I guess it makes most sense to start the review from the monthly performance. We closed last month up 1.55%, and we've only lost less than 0.5% on this incredible fall that we had in the past few days, and that's mainly because we own so many very nice short-term bonds. Now, I've taken the position down to 30 shares of SPY because we closed below the 540 SPY level where our calls are struck. That's the value of the remaining value of the calls, and 0.55 is all we can lose further. So should that be the situation, we would only have 10% in equities below our minimum allocation of 20%, which is self-imposed, but we are happy with that situation. We would be, very nicely positioned in bonds and in cash. We would have very, very safe and defensive portfolio. We are very happy with this portfolio. And what would we like to do? Well, as indicated in the video, we'd like to sell some short-dated puts on SPY, but the precise strike quantity and the limit price that we'll be doing at, we will email you sometime next week. It could easily be Monday morning, but expect an email anytime that the market has a nasty bout of degrossing, and we can pick a very nice strike price and sell a very low risk put that would take us back above 20% in our allocation in equities should it be exercised. We will do that anytime during the course of the week, and we will naturally send you the update immediately. Broker statements are updated, as is the monthly performance and the statement, so it's all there for you to look at. Again, the monthly performance, we're very happy with it. All we need to do is catch a nice low in equities and then have a good rest of the year. Thank you very much indeed, and speak to you next week.